What's cracking, everybody? Money Smart Guy Matt Sapaula here. Hey, Lindsay here from Dallas, Texas. And if you didn't know yet, I am the author of Keep the Keys, my third book, 3 times bestseller here on Amazon. And for 26 years, I've helped thousands of families protect their homes and build strategies, financial strategies that actually work during the worst of times. I sat across from widows, veterans, and real estate investors and homeowners who thought that equity inside the house meant security until life proved them wrong. And I've interviewed experts at the highest level when it comes to this topic, even economists from the Federal Reserve Bank of Chicago. And their conversation with me backs up exactly what I'm about to share with you in this episode. So the headlines right now are all about rate cuts. Rate cuts, rate cuts, rate cuts. And the economy, in my opinion, is soft. That's pushing the mortgage rates down. And I believe that right now, here, even in Dallas, there's over 5,600 homes for sale, and over 1,500 of them recently just dropped their prices to hopefully effectively sell their house sooner than the rest of the competition. And as of September 2025, the average 30-year fixed rate is still around 6.55%. Now, that sounds like good news, right? Wrong. Because when rates dip, home prices are also dropping. Again, here in Dallas, almost 25% of homes for sale have reduced their prices. That means what? Equity. People's retirement stuck in a house. That's a thing that most people count on is now actually starting to slip away. See, here's the reality. You can't eat equity. You can't pay bills with equity. And when values drop, that trapped equity starts to evaporate. So the real danger isn't high interest rates. The real danger is you depending on the Federal Reserve Bank or the market to hopefully bail you out. And here's the biggest mistake that I see homeowners make. They confuse ownership with control. Just because you got the title to something doesn't mean you actually control it. You see, they rush to pay off their mortgage early, thinking that it's safety. But all it does is hand liquidity away from you to the bank. That's not safety. That's surrender. If you're a homeowner, you're a real estate investor, or you're a realtor, or you're a loan officer, a tax professional, here are 3 steps that all your clients who use a homeowner or real estate investor should incorporate. Number 1, start with term insurance, but make it smart. Forget PMI. If you're paying private mortgage insurance, it's for the bank, not you. The worst case scenario happens to you. The banks get paid off, not you. Protect your family first. The banks are. So get a cheap term life insurance policy with living benefits. And I promise you, all the major life insurance companies out there that you may think of, I promise you, many of them do not have living benefits. And there's a difference between living benefits and terminal illness benefits. 2 different scenarios of which a life insurance company sends you cash while you're alive if you're going through a change in health. You want to make sure it's not terminal insurance, although that's important, but even better, because what happens if you survive a heart attack, stroke, or cancer, and you survive and you're not terminally ill? You want to make sure a living benefit in that policy pays you while you're alive. And once again, if you face cancer, a stroke, or disability, you can tap into that coverage while you're alive. More importantly, you keep that mortgage covered. You keep your bills paid. This is your financial bridge, your financial umbrella. Start with term. It's very inexpensive. Later, you can convert that into permanent coverage. I'll cover that here in step number 3. But step 1 protects your family, not the bank, not the lender, you. Step number 2, redirect extra overpayments that you send into your mortgage into an index universal life policy. And here's where most people mess up. They send extra payments to the bank. Why? They try to pay off that mortgage early, thinking, oh my gosh, I'm doing my duty to accelerate the payment on my house, but that only builds trapped equity. I actually interviewed the economist at the Federal Reserve Bank of Chicago. His name is Gino Rahman. It was in 08-09. He co-authored a study on the exact trade-off on sending mortgage prepayments versus taking that same money and redirecting that to what? Tax-deferred savings. His research showed that Americans are misallocating that cash flow, that they're actually giving up security just to shave a few years off a loan and get into $1 billion mistake. Instead, redirect those same dollars. If you qualify for it, into a Roth IRA, or if you have too much more money, redirect that into a index universal life policy, even better, structured under IRS code 7702. Why? Because this is the only financial vehicle in America today that lets you grow money without paying a diamond tax, access that money without a diamond tax, and transfer that money in a bigger value to the next beneficiaries, to the next generation without paying a dime in income tax. You know, something happens to you, it instantly creates a liquid tax-free estate for your heirs. Only financial vehicle able to do that. Roth IRA doesn't do that. A properly structured index universal life policy does that. Now, the Fed's research proves the old way is inefficient. The keep the keys way puts you in control. Step number 3, reposition trapped equity under your control, not inside your property, but under your control. See, equity feels safe on the balance sheet, on the spreadsheet, but it's useless if you can't access it. You can't pay for groceries with a good appraisal. Smart families reposition equity before a crisis. And by the way, quick pause. I remember when watching this Hurricane Katrina fiasco, the whole 20-year anniversary of Hurricane Katrina right now is on Netflix. I remember a scenario where people were rushing out to leave, departing New Orleans. And homeowners, real estate investors who had their line of credit, their home equity lines of credit through their credit card, because that's how that bank issued a line of credit, was through swiping of a credit card. Long gone are the cutting a check to access your line of credit. And guess what happened to that credit card equity tapped into through use of a credit card? They froze those lines of credit. That's why you need to be in control of your equity, not the bank. And this could mean refinancing strategically and moving those funds after cash out refinance into cash value insurance, annuities, or trusts. Point is simple. Your dollars stay under your control. And when life hits, like layoffs, a change in health, inflation, you decide what happens, not the market, not the bank, not the government. And here's something exciting. I'm taking this Keep the Keys message on the road. The Keep the Keys book tour is happening right now. I was just in Miami last week. Next up is Chicago, San Antonio, Sacramento, Las Vegas, Little Rock, Arkansas, Washington, D.C., and more. How to find out where you can reach me? Go to my website, keepthekeysbook.com, to see the full schedule and find out which city I'll be in next. And if you're in real estate or a mortgage broker or a tax professional, you can even host this as a client appreciation. Me coming out there, all I need is a minimum of 100 people in the room. I'll go out there and I'll do a live book signing for your people and do an educational process of keep the keys type of strategies to help your clients not only get the keys, but also make sure they keep the keys during tough times, and everybody faces tough times. So if you're interested, drop tour stop in the comment section below, and my team will send you the information so we can connect and make this happen. So wrap up. Let me ask you this. If your financial plan only works when rates go down, do you really have a plan? So please stop hoping for a federal bailout. Stop waiting for church or chair or somebody else to help you out. You build a strategy that works in any condition. Military train kicks in for me. Plan for the worst, but expect the best. That's how you keep the keys. Now, I put together a free download for you to access on my Keep the Keys scorecard. You can access it at my website, keepthekeysbook.com, so you can stress test your own financial house. And the link is in the description, in the comment section below, or in the description of this video. Now, if this opened your eyes and you haven't done so yet, please hit subscribe, hit like. Please put your biggest takeaway in the comment section below. Because every week, I break down what the headlines really mean for your family's financial security. If you haven't seen that yet, make sure you watch these other episodes here on the Keep the Keys strategies. And also keep in mind this too as well. Every Tuesday, 2 p.m. Central Standard Time, I do a live video reaction to what's going on in the economy and financial news to help you stay ahead. So therefore, you can start thinking like a millionaire, strategize like a millionaire. So therefore, you can be a first-generation cash flow millionaire. From Dallas, Texas, I'm your money smart guy. And until we meet again, continue smart, continue love smart, and be money smart today.